This is the US Federal Reserve's own recession model. It estimates the probability of a recession happening within the next 12 months, and it has just triggered a major signal that we've only seen a handful of times before. This signal is telling us that everything is about to change for the US economy. Now, first, you might be confused seeing their model showing the probability of a recession actually going down. Over the last few months, we've seen a string of horrible job numbers released by the US government. The ADP job report turned negative for the first time since the pandemic. The non-farm payroll report suggests we've seen the lowest number of jobs added to the US economy since the pandemic. Such slow job growth is comparable to what we saw right before the Great Financial Crisis and also right before the 2001 recession. And finally, the US unemployment rate has risen by almost a full percentage point over the last year and a half, something that we have never seen outside of an economic recession. The slowdown in job creation is something that the chair of the Federal Reserve, Jerome Powell, has recently stated is becoming a real risk to the economy. So on the one hand, we have serious recessionary economic data and the Federal Reserve themselves saying that recessionary risks are real, and on the other, we have the Fed's own recession model saying the exact opposite. Now, the recession model is based on the yield curve, a notorious recession indicator that uses spreads in the bond market to evaluate how tight or loose liquidity is in the financial system. And so the Fed has used the yield curve's information to build a model that puts a clear probability of a recession happening in the next 12 months. When their model is at elevated levels, it suggests that liquidity conditions are very tight and more likely to lead to an economic slowdown. And as we can see, that's historically been very accurate, with tight liquidity conditions systematically preceding recessions. On the flip side, when their model is at low levels, it tells us that liquidity conditions are loose, and that is historically something that we only see outside of economic recessions, what you could label as periods of economic stability or even booms. In fact, what typically happens is that you see liquidity tighten up right before an economic downturn occurs, the recession happens, and then liquidity loosens up again after the recession ends, leading to an extensive period of economic stability. What is very strange about today is that we saw the model spike to quite high levels, but we never saw an economic recession occur. And yet what we're seeing now is that the model is coming back down, just like what we typically see after an economic recession. And theoretically, this signal should mean that we're entering a new period of economic stability. But it is fair to question the validity of this most recent signal given the fact that no recession occurred as a result of the tight conditions in 2023 and 2024. Well, if we add the unemployment rate on top, we understand much more clearly what is happening. Here we clearly see that every time liquidity dries up, it's shortly followed by a rise in the unemployment rate, which of course coincides with economic recessions. And today's situation is actually no different. The tightening of liquidity that we had in 2023 and 2024 did lead to a pretty substantial rise in the unemployment rate, and as we mentioned earlier, there are a lot of data points that suggest we're right on the brink of having the economy tip into a recession. Now, what's fascinating is that if we shift forward the Federal Reserve's recession probability model by around a year, we see that all of the peaks of the recession probability model align with the peaks in the unemployment rate. So in other words, when liquidity tightens up, the unemployment rate tends to rise for the next year. And when it loosens back up, the unemployment rate falls back down for the next year. So today, the recession probability model of the Federal Reserve is telling us that the unemployment rate is peaking. And this is something that we've been arguing for the last few months now. However bad the situation might look today, we could be set to see at least a temporary improvement in the economy as a result of this loosening of liquidity. But there is a big nuance to this, and that is that this model is still hovering at 30%, which is still extremely high. And it's very different to what we typically see after real economic recessions, where the probability of a recession gets crushed down to zero. So yes, liquidity conditions have loosened up, but they're not loose by any means. And we have real data from banks that shows us exactly what's happening in the banking system. This is data from a Federal Reserve survey showing the percentage of domestic banks in the US that are tightening their lending standards to corporations. As we can see, the survey also has a good track record at anticipating anticipating recessions, with banks tightening their lending standards in the months heading into official economic recessions. Before the 1990, the 2001, and the 2008 recessions, domestic banks were tightening their lending, and in the aftermath of these recessions, domestic banks loosened their lending standards considerably, with this survey dipping below zero. If we add the US unemployment rate again, and we shift forward the chart of lending standards again by a year, we can see how closely these two lines match. So in other words, the banking system's tightness predicts whether the job market will deteriorate or improve. And as you can see, the survey is still sitting at quite high levels, not at all telling us that domestic banks are loosening their standards. So although we don't think that the unemployment rate is going to rise substantially in the coming months, we also don't think we're due for an extended period of prosperity with the unemployment rate plummeting down. The more likely scenario is that we just see more of the same struggling type of economic environment over the next year. Needless to say that this has been a fantastic environment to be long on the stock market. We think the current price action of the S&P 500 still points to additional upside in the coming months, even if some short-term volatility is in the cards. We've been riding trades like Zscaler, Applied Materials, Natera, PWR for double-digit gains just on this most recent rally, and we are now booking some profits on these, but we do expect to be aggressively long on the market over the coming months. Our trading strategy allows our clients to make money both on the way up, being exposed to the strongest stocks in the market, but also protect ourselves on the way down when the tide turns. We show you everything we know at bravosresearch.com, along with each and every trade that we take on the market, so make sure you are subscribed. Thank you for watching.